President and CEO of McDonald's, Chris Kempczinski, joins us this morning to break down the quarter in a CNBC exclusive. Chris, it's great to have you back. Thanks for the time.
Thanks, Carl. Good to be here.
We don't usually start every CEO with discussion about the share price, but it's been on such a run. I got to ask you what you think the market has been responding to, or at least trying to anticipate, whether that's a China reopening or a pivot to more unit growth. What do you think's been at work?
I think for us, fortunately, our business has been performing really well for the last several years. And I think what has been playing out is essentially continued optimism about McDonald's performance, the ability for this business to succeed, whether it's a challenging macroeconomic environment or a benign economic environment. So I think it's just overall enthusiasm, optimism about our strategy, the state of the business, and the outlook going forward.
We mentioned the discussion of inflation still crimping some margins, and the analysts did have some notes about EBIT margins this morning. Can you sort of frame that? And is the picture getting better U.S. than it is, say, in Europe?
Yeah, we've been facing quite a bit of inflation. Last year, we faced double-digit inflation globally. And even in Q1, we are still experiencing double-digit inflation. Now, our outlook for the balance of the year, we do expect it to get more favorable. But net, still by the end of the year, we're going to be looking at, I think, probably high single-digit inflation on a full year, which is certainly much elevated than what we've been used to over the last, kind of prior period where we typically would be in the low single digits. So that is pressuring margins. We're trying to be very thoughtful about how quickly we pass on this pricing to consumers. We understand the role that McDonald's plays from a value standpoint. And I've been proud about how our franchisees and our system have been very judicious about how we've done it. But it has, as you pointed out, put some pressure on margins in the short term. I expect we'll work our way through that over time.
Chris, it's Sarah. Where is it coming from specifically? Is it just the stubbornly high food costs? Is it labor costs? What is moderating and what is not?
Yeah, good to hear from you again, Sarah. For us, it's broad-based. We're seeing it across the board. Labor inflation for us is mid to high single digit. If you think about some of our input costs, price of grain is quite elevated right now. That actually flows through to the proteins because a lot of the feedstock that's used for chicken, beef, et cetera, is grain-based. So we're seeing it across almost the entire basket of goods that we're experiencing inflation, in addition to the labor inflation that I talked about.
So on the other side, you've been doing this restructuring. You mentioned the layoffs, which we reported on. What's the earnings benefit overall to what you're doing?
The way we looked at the restructuring, it was not about trying to get a G&A savings. It was much more for us about changing our ways of working. And one of the things that I wanted us to be able to do is we need to be able to be faster as an organization. We need to be more innovative. We need to be more efficient. And I saw things with how we were organized, how we were working, that were going to get in the way of that. And so one of the things we took a look at with the senior team over the last 6 months is how do we change our ways of working? We need to stop working in silos. We need to stop having every market try to invent its own light bulb, so to speak. And we need to do a much better job of digitizing the organization. So that was the impetus for taking a look at the organization. And unfortunately, as you noted, it did result in some people leaving us. But it came from a place about how do we actually get better as an organization as opposed to trying to hit a specific savings number.